Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts on the show. Joining us on the show today are Ritesh Ashar of KIFS Trade Capital, Umesh Mehta of Semco Securities, while Sangeet Lakkar of Newberry Capitals will join us in a bit. But what are we discussing on the show today? We discuss Piramal Enterprises. The counter after spiking yesterday is down in trade today. We asked whether the stake sale in Shriram Transport was strategic or does it indicate signs of stress for the company. We also discussed the tire stocks or whether any tire stock is worth buying at the current level. Yesterday, a big block deal in Apollo Tyres saw the counter move up 10%, but today it's down in trade. Yes Bank, on similar lines to IndusInd Bank, has seen multiple analyst downgrades and souring of sentiment. The management has spoken of a fundraising in the second quarter, but we asked the analyst whether it will be prudent to do any kind of bottom fishing on the counter. And lastly, we asked our analyst about one top large cap or mid cap stock that they have recommended to their clients recently, which should be held for at least a year, a long-term investment. But we start with the first stock, and that is Piramal Enterprises. Let's pull up the counter. The counter has corrected almost 3% in trade yesterday. It opened up cap up, and then yesterday came the big block deal in the morning where they exited the entire 10% stake they hold in Shriram Transport. Remember, they still hold stake in Shriram City Union Finance and Shriram Capital, which is the unlisted company. But is this sign of stress for Piramal Enterprises given what's happening, or is it a good thing that they got out of Shriram? That's something that we'll ask. Umesh, what's your sense on this entire deal they sold? Which side are you on? Do you believe that you know the asset was not generating returns, it was good to get out? Or secondly, it shows that there is stress and they need to get out of certain assets because of the issues that are there offhand?
Correct. So no doubt that we are facing current liquidity crisis is there in NBFC sector. But the best part of Piramal Enterprises, they thought that now there is crisis, let us take the opportunity. And they had an asset that was liquid. So it is good that they got off from that liquid asset and sold at or near decent valuation. So valuation was quite little bit cheaper, but that's okay. The money that they will get, they will deploy in getting the larger spreads which from the realty sector, which they currently have a part of the portfolio. So it is in a way blessing in disguise. The earlier investment that they did, but now thinking that now the current business, the portfolio that they have can generate larger return rather than keeping funds invested in 18% ROE business and financing into larger truck operations. So I think that is a good strategic move. And given that they have further investments worth around 5,000 crores, and sooner or later I think they will get rid of this entire portfolio, and the funds that they have, they will be able to generate higher returns on the capital. So I think broadly, and plus finance is a business of trust, and I don't think Piramal Enterprises has lost that trust, and they can be the next HDFC's sort of conglomerate, given that they have capital and now that liquidity has been they will get liquidity, and therefore they have a larger aspirations that they can become a larger NBFC with brand name, with pedigree of.
But it's not about trust. The point is that they have lent to certain lenders who the market perceives probably could default. One of the names that's floating around is Lotha. They also have an exposure. So they're basically lending to a sector which is not seeing inventory built up and sales not happening. Their domestic pharma business hasn't done much there. So is that so? If someone is looking to take a position, is it something that they should accumulate Piramal, or what's your sense on the counter?
See, always there will be at times, in a decade's time, wherein the real economy and financial economy will get friction. So because real economy is not liquid, so all builders, they have property, they have assets, but the problem is now they can generate liquidity. Answer may be no, but still the value of asset is there. So it is not that it will go in thin air. And currently finance sector is having confidence of crisis, and therefore people want their money back. So liquidity mismatch in real economy and financial economy is a problem. So this ideally is a good opportunity to, number one, if you are in business, I think if you have capital, this is great time to lend and plan for that long term. And Piramal Enterprises, I think, will surely be able to do it very, very astutely, because they have a good book. they have a good track record, they have low NPAs, and I think they will be good they will become larger than what they are. So the speed of growth for Piramal Enterprises because of this NBFC crisis is much better. The prospects have really become far more better than earlier had this crisis had not emerged.
What's your sense, Ritesh? What have you advised clients? Are you seeing this as an opportunity to buy, or is it a concern that investors should exit this counter?
See, right now at this price, definitely it is not advised for an exit. It's better to hold the position, but definitely the new investment is not advisable in this counter, or rather overall has an NBFC or as a financial sector for this matter. Definitely I would agree with there is a lot of financial crunches is going on in the industry from last almost more than 6 months now, and there are a lot of issues are going on in terms of affordable housing finance and the real estate sector for this matter. It is absolutely considered to be a strategic move by Piramal Enterprises when it comes to an NBFC strategic move. Compared to other NBFCs, right now debt to equity is running at around 11x, as compared to Piramal is running at around 3.91, which is comparatively far better compared to the other peer groups in terms of NBFC. So I personally feel overall the structure looks to be good, and it is a strategy move wherein in this strategy move the company has decided to switch over from Shriram Transport and get the liquidity to be done and try to make sure that the affordable housing finance business and the real estate business to take it forward. Right now there is a perception about the real estate sector wherein the loan book is running at around 54,000 crores and they have an exposure of around 40,000 crores. So because of that reason the counter is under quite pressure. But overall it seems to be like it should be a stay away right now as a financial sector for next 3 to 6 months of time. Let the debt to equity ratio will come into the decent stage, then there will be probably a fair value for the long term perspective.
Okay, Sangeet, I think traffic held you, but we were discussing Piramal Enterprises and yesterday was the big news of them selling their entire stake in Shriram Transport. On what side are you? Do you believe that it's a good exit that they are taking? Is it a good move, or does it indicate to you any kind of stress that the management is forced to take such a decision?
So I don't think management is forced to take such a decision. I mean, Piramal Enterprise has a history of investing in good businesses and exiting at decent returns. Although this exit has not been at the returns which they would have expected. But I think they had strategic plans for this acquisition when they did. They also tried to merge it with a bank initially, but then I think somewhere it was not fitting in the scheme of things. Then they eventually, and obviously I'm sure the liquidity concerns also weighed on this decision, but they have exited, and they have exited at 40% premium, although the CAGR returns may not be that impressive. But I think having said that, the valuations at which Piramal is trading is attractive. Though I think near-term pains would persist because of their exposure to real estate sector, and I don't see a real estate sector really picking up in near future. But having said that, they have a decent pharma exposure also. They have about 35% business coming from pharma. So I'm near term, I mean, it's a buy on dips for me. However, one concern I would like to point out is LIC has suddenly increased its stake. I mean, in the last about 4-5 months, LIC now holds about close to 7% of the company. And whenever LIC increases substantial stake in a company, I'm a little wary of.
Okay, any reason why?
I mean, I don't know. I mean, I'll reserve my comments on that, but then that is something to watch out for.
Okay, so that's an observation that he's done, but nevertheless, as he pointed out, it was close to 42% returns that Piramal made over the past 6 years when they invested in Shriram Transport, and obviously, as he pointed out, the CAGR on that stage will be lower. The other interesting trend that happened yesterday, probably it could be a one-day wonder, and that was the up move in tire stocks, and especially Apollo Tyres. A big block deal that happened in trade, and the counter was up almost 10%. Today, it seems to be correcting. Yesterday, along with Apollo, it took the entire tire sector up with it. But this sector has not been finding favor with investors, at least for the last few months. Results haven't been most impressive. Are valuations still expensive? Is it the right time to start accumulating tire? And if yes, which is the counter? Ritesh, any of the tire stocks that you've recently recommended to your clients, or is that something that you stay away from?
Definitely, Darshan, it is absolutely stay away from this particular sector. So we have not recommended any of the stock particular investment in terms of tire. There are 2-3 fundamental reasons behind it. If you look at the raw material price has increased drastically in terms of globe. In India, it is 11,400 rupee to it has moved to 14,000 rupee, which is almost appreciated and affected the margin per se for this matter. Simultaneously, the primary OPE what we are talking about is that is also affected badly because the demand is too low in terms of auto sales numbers, and thus at the same time the alternative sales is also not picking up so fast. So overall the demand is quite less, and at the same time raw material prices increasing, which is affecting the profit margin also for this matter. So I think in terms of performance from last 2 quarters, if you're talking about, it is not really up to the mark the way it should be. So I think right now still I'm expecting tire to be more correcting zone. So I think stay away and sell on rising will be more advisable.
Okay, Vish, what's your sense on the tire space? Do you all recommend any of the tire stocks to your clients recently?
So tire is typically a semi-cyclical business. So it is not absolute cyclical business because you have that replacement demand that keeps the wheel going. But because of slowdown in auto sector, I think tire sector has also corrected slightly higher than what it warranted. But the best way to play tire sector is buy when they are available in single digit PE multiple and sell when things are double digit. So historically 10-year PE multiple band tire sector comes on near around 40%. So still there is some it is possible that it can come down so that valuations becomes little bit more attractive. But from an SIP, if an investor wants to do a systematic investment, I think tire sector, good tire companies are available. MRF, Balkrishna, BKT has done even expansion, and I think they have a sort of monopolistic position, and no one is going to take that. So that cash generating ability of the business has not been impaired and will not be impaired because of so-called EV and so on. So ultimately it's a matter of valuation. So valuations are decent, slightly lower would be preferred, but there is nothing wrong as such in if people want to invest for long term.
Which one? So which is among the tire, which is the best pick?
So number one is here in MRF and there by BKT.
Okay, I was just seeing the graphic on the valuations that was put up 21 times for an MRF. I believe a few years ago it was trading in probably low single digit or high or in low double digit or high single digit. It was 8 to 10% or 8 to 12%, that was the range, but still the PE has come up significantly. Sangeet, any of the tire stocks that you all have recommended your clients, or you believe that it's basically a cyclical industry, you think that we've hit the bottom and then there'll be a rise, or still there's time to go?
So I don't think we can ever catch the bottom.
Yeah.
But I completely agree with Umesh that we are passing through a down cycle, and it's a completely cyclical industry then way to play cyclicals is you have to accumulate on dips, and when the cycle turns you have to kind of exit out. And the best player to buy would be the one having the strongest balance sheet, which is MRF. Because that's when the cycle turns, they would be in a better position to capture the market share. In terms of my top pick, it still remains Balkrishna Industries. I mean, I've been reiterating my call since last a year or so. So it's a completely different from a passenger vehicle industry as such. The margin profile is very, very different. It's upwards of 26%. Whereas for a normal passenger vehicle tire company would be about 15-16%. Also 90% is exports. They don't have a domestic exposure, and they don't compete. It's not a commodity business when the margin profiling is upwards of 25%. And there's no threat from Chinese imports because they have about 2,600 SKUs. So it's a very, very labor intensive industry. They have to compete. It's like a labor arbitrage between, from the manufacturers from the US and the Europe side. And whereas a normal SKU for an MRF or from any passenger vehicle tire would be about 20-25. So they are always susceptible or prone to Chinese dumping. And they have announced a capex as Umesh mentioned, so the management looks optimistic on the business. It's just a cycle that is against them. So when the cycle turns, I think they will benefit from this.
Okay, that's the view that's coming in on the tire stock at this point of time. The next stock is again interesting. It's one counter which has corrected significantly ever since Rana Kapoor came out of the company from the board. There has been continuous selling. The new CEO came in, the counter did manage to rise, but then again it's all the way down for Yes Bank. It's down to 116. A lot of brokerage reports have started coming in with targets sub 100. So that's the view on Yes Bank. Is it time to bottom fish in Yes Bank, or there are other better private sector banks that you need to look out? Sangeet, you believe cleanup has happened, or there are more skeletons in the cupboard?
I don't think so. I mean, the kind of exposures which are surfacing now, practically they have exposures to all the questionable business groups, and that's how I believe the underwriting practices at the bank is under severe question. Last they had a terrific growth rate of upwards of 20-25% consistently for last 5-6 years. And the test of the bank is, or any financial institution is tested in this cycle. And I think it's going. There are some more pains left. They have been consistent, lapses in the compliance part. The RBI has observed it, and with the new CEO at helm, it's not very easy to come out of this mess and then again start growing. I mean, it's going to take a long period of time. The only possible play could be if it gets acquired or something. That's the only thing. But I mean, it's too speculative play to play on that. So I would stay away.
Okay, you think that the new CEO will be able to turn it around eventually? You said it will take time, but does that give you any kind of confidence that a lot of the old members are resigning from the board, new members are coming in? Is that, and we've seen Yes Bank go through this I think twice before, where the stock corrected 50-60% and then managed to recover?
I have my doubts. I mean, if he can turn, I mean, only time will tell whether he can turn around things. But I have my doubts, honestly.
Okay, what's your sense, Ritesh? What have you recommended on Yes Bank?
So if you look at overall compliance issues by objected and questioned by RBI for this matter, management changes, all the structure issues, I think it is factoring.
Okay.
The surprising part was Yes Bank was the NPA have been declared in last quarter, which is very surprising. At the same time, the profit was expected and the bank has declared as a loss. That was also a question mark. But if you look at overall book size, it is around 26,900 crores. Against that, if I consider last year NPA declared as 5,000 crores. So if I look to price to book value, it comes to around between 90-95. But if I factoring in terms of percentage terms and the ratio, it comes to 1.3. So I feel 116 and 120 is considered to be a fair value to entering into for a long-term perspective. And definitely below 115, it is treated to be a lucrative buying opportunity. Definitely in a shorter term, you cannot expect good bounce back due to whatever the announcement may expected. But definitely for the long-term point of view, if you'll invest into this particular counter, definitely 20-30% appreciation is expected for a long-term horizon.
Okay, so invest for the long term is something that Ritesh is talking about. Umesh, what's your sense on Yes Bank? Obviously, a lot of your clients must have asked you what's going on, and they must be saying the stock is down 40, 50, 60%, and that also a frontline bank coming close to 100. A lot of people get excited if it goes into double digit, so they'll feel that it's much cheaper. But what's your sense?
Actually, when crisis comes, the thinking capacity of human beings get impaired. So I think that's the way we start with. If yes, so India Bulls, they want to enter into financial sector. Why? Because it's lucrative and the potential is huge. So the good point is you have a strong regulator in India. You have a new CEO is in place. There is a shuffle in the management. Maybe things. So it is better to give a benefit of doubt and bet on the side that things will become better. Because given that these valuations are same as of what PSU Bank, and PSU Bank you have GNPAs upwards of 10%, and this bank has still GNPA in around 3.5%. So assuming the worst case scenario, still they are better than because it's a private. Still, you have a private management, you have professional management, right? To be precise. So there is every chance that things can really turn. So what will turn? So I think the best would be for an investor because numbers, he has to wait for numbers, because if the growth, if the team is there, and if the same team that delivered in the past 35% plus growth, and if the same team is there, and if they are able to deliver even 30% growth in net interest income, number one. Number two, if the cost to income ratio really does not drastically deteriorate, then I think, although yes, maybe company will report loss because they will clean up. But I think if operating parameters are still intact, there is every reason why I think the bank will bounce back, and I think that will give a very good risk-reward ratio. So this is a stock for investor who has risk, and if they want to take risk, I think you have no other. This is a very good opportunity to take the risk upon.
Okay, that's the view that's coming in on Yes Bank. Two of our guests do believe that it's a long-term bet. The risk-return ratio is clearly in favor of returns at this point of time. And finally, since the markets are wobbly, a couple of stocks are available at much lower valuation. I wouldn't say cheap valuation. I would say much lower valuation than you could have gotten them at least a few quarters ago or a few months ago. Is there some stock that that our guests are recommending their clients that don't go all out and buy, but start nibbling into these counters? Umesh, which is that one stock that you've recently told your clients, okay, the valuation looks good, everything looks good, and as you point out, risk reward probably is in favor of reward now?
So yesterday or day before yesterday only we had recommended Tata Elxsi.
Okay.
So I think Tata Elxsi is a typical one IT stock which has been dragged down with the auto sector. But the difference is, in auto sector, companies will have to do capex either for BS6 norms or in future for electric vehicle. But Tata Elxsi does not have to do any capex. So I think the incremental capital investment is not there, and the same team will be able to deliver growth. But because of slight slowdown in automobile, this stock is available at a very, very decent valuation. I think this stock has got same operating margin as that of TCS, same ROEs of that of TCS, growth is double than TCS, and valuation is half of TCS. I think it's a great stock, great opportunity. The business verticals that they are into, I think they cater to multiple verticals: digital, communication, transport, telecom, and I think all those levers will be there. Those business will keep on generating free cash flow, and I think it's a great stock. The growth, 35 or 30% CAGR growth that we haven't seen in IT stocks. TCS is growing at around 10-12% and PE multiple is at 25. And Tata Elxsi is growing at around 30% and PE multiple is at just 18. I think it's a no-brainer investment from a long-term perspective.
Okay, Tata Elxsi is the stock that Umesh speaks about. Ritesh, what's the stock that you've recently recommended to your clients?
I will be bet on the IT sector, that is NIIT Tech.
Okay.
If you look at overall valuation perspective in terms of product and the distribution of services provided by NIIT Tech, it is a fantastic. If you look at BFSI segment contributes almost 44%, manufacturing and transport manufacturing is contributed around 20%, transport is also contributed around 18% of the revenue, and it is absolutely diversified in terms of servicing, in terms of technology. But if you look at overall worldwide also, Africa, they have a market share of almost 49% and generating a decent amount of revenue. And in terms of revenue contribution from the Africa is also 28%, and rest of the world is around 18%. And if you look at overall digital performance, which is on year basis, it is growing at around 30%, and quarter on quarter it is roughly running at around 5.6%, which is on the last quarter they have reported. So I feel overall demand of the product and the service standard of NIIT Tech, it is fantastic, and it is going to be a continue. Looking at the transformation of the industry from the manual activities to the technology driven. So I feel the demand of the product is going to be continued. So it is a strongly recommended for the long-term horizon.
Okay, so Tata Elxsi, NIIT Tech is being spoken about, and finally, Sangeet, what have you recommended to your clients recently?
So I have chosen Reliance Nippon Asset Management.
Okay.
I mean, as you mentioned that, we are living in a slightly wobbly environment. Globally, there are headwinds of trade war. Domestically, you might have a shock from the rain gods. So this is kind of a quasi equity exposure. So there is an open offer by Nippon at $230. The share price now is about 220, 219. It hovers around that range. So even if I have to exclude all the business, all the assets, the shareholding, the minority shareholding is about 25% after the ADAG's OFS last week, and the open offer is for about 22.5%. So there will be 100% acceptance ratio. So that gives about return of about 6.5% over a 2 months period, which is kind of a guaranteed assured return kind of thing. So that this gives me a little capital protection as well as my caps my downside. Now on the business front, it is the largest AMC in India by AUM. It is also the largest AMC in terms of retail assets and the ETFs. Trades at about 40% discount to the peers like HDFC AMC. And the only reason I could foresee that it trades at discount is because of the ADAG name attached. Now with ADAG moving out of the business and Nippon acquiring the entire 75%, it may not probably trade at HDFC's valuation, but definitely it does not warrant a 40% discount to the valuation. So that is one rationale, and I think it has a long runway for growth in terms of financialization of savings. The kind of SIP growths that we have seen, they already have about 10,000 crores in SIP right now. So it's a pretty kind of a stable set of income. They will continue to do well. So I mean, I've chosen a little safe bet today.
Okay, that's the view that's coming in. 3 stocks that were selected yesterday by our guest include counters like a Tata Elxsi, NIT Tech, as well as Reliance Nippon Asset Management. So those are the stocks that you need to watch out for. But with that, it's a wrap on today's edition of Hot Money. Let me thank all my guests for coming in. Thank you so much, Umesh, for coming in. Ritesh, Sangeet, thank you for coming in today. Ask BQ comes up next. Stay tuned to Bloomberg Quint.